Oh no, it's going to talk. Great. Hey everyone, it's Niki Shelton with Keeping It Real, and I'm here with Kerri Selby with Fairway Mortgage. Kerri, how are you doing today?
Doing good. I survived what was supposed to be freezing rain and craziness, so happy to be here.
Well, at least you didn't get all that. Very happy. I've heard there's some other places like up, I think by maybe by Bellingham, it's starting to get some in the area, or up further north up that way from you. Because I was talking to some other people earlier today, and it sounded like it's kind of all over the place. That expecting it but not happening, and then some places got it. So, and
But
here
nothing
we're
compared to you.
I know, right? We're finally digging out a little bit. I was out there like 4 days in a row digging and digging. We had like about, I don't know, 24 inches of snow almost probably. So it's all said and done, and cold, very cold here. So
Yeah. We're at like 30. You're at negative 30, you said, right?
yeah, so we have about a six. Well, actually, it's almost 40. So we're at about a 70-degree difference from you guys. So,
Whew.
you know, when I hear you guys complaining, I just like laugh.
Yeah, that's that kind of coldness when you go outside. It takes your breath away. People don't realize that. I experienced that for the first
you
time.
get frostbite in about 10 seconds with exposed skin, is what they're saying.
Ooh,
so,
my gosh.
yeah. So I had my heated. And by the way, if you don't have a heated coat or heated gloves, I highly recommend, because the top part of me was toasty and warm, and I was out there and having a great old time. I had my hood on, and but my bottom part, oh gosh, it was cold.
You're like, I need heated pants next.
I'm looking into that. I am looking into that.
Nice.
Okay, so last week we talked a little bit about kind of just the different types of loan. So let's say that I'm a buyer today, and I've been doing my budgeting. I want to know what budget is and what I can comfortably, what I think I can do every month as far as, maybe it's like I've got a rental that I'm paying on right now or something like that. Or I've got a current mortgage, but I'm trying to figure out where I'm at as far as finances. And I do that, sit down and I figure that out myself. This is kind of what I have. And then I kind of think, okay, now I've been saving up my money. I've got my closing costs. I know these are all important things as far as, and we're going to go into some of this more in detail. So if you don't know what closing costs is, don't worry about it. We'll hit it in a little bit. But, I'm kind of putting that together to start talking to a lender, talking to a realtor. And now I'm ready to go sit down with my lender. Maybe I talk to a realtor and they referred me to a wonderful lender like Kerri, or, maybe it's vice versa. They talk to the lender first. They know somebody in the field and they talk to the lender first. And that's where they're at right now. So now I'm going to sit down with my favorite lender, Kerri. I'm going to say, Kerri, okay, I've kind of ran my own numbers. I really think I can buy this house or buy a house now. This is what I got. Here's all my information. These are all the things you've asked for, because I'm giving you a ton of information, right?
Yes, you are a true unicorn if you have all of that done.
Well, I like to prepare, and if not, you're going to tell me what I need to do still. I'm sure I haven't thought of it all, but I'm thinking this is what I need. I've kind of done some research on my own. So let's go in and kind of talk. So I walk in, Kerri, and I says, okay, I heard about fixed rates. I've heard about variable rates. I've heard about conventional, FHA, VA. I mean, help. What do I do?
Where do I even start?
Where do I start? Exactly. Because lending is not my favorite topic. I like to talk about a lot of other stuff, but I try to let Kerri handle that. So let's go ahead and pull in our loans program, and Kerri, I'll let you take it from here, and you can tell me what I'm going to do and how I get prepared for all this and what I need to know about each loan.
I can do that. What the heck happened right there?
About what?
It just jumped to the next one. Oh, okay. You did that. Okay. So we really went over some of this.
Loan programs at a glance.
I just thought it. I moved my mouse, so I totally thought that I did that. I was like, oh, did it jump to the end? Love when it's live.
I got you covered.
So last week, you probably heard all of these terms that we're going to discuss today: conventional, FHA, USDA, VA, jumbo. And you're like, well, guess what, Kerri? You're speaking a foreign language to me, because I have no idea what any of those mean. Here it is, all laid out. If you need to come back and reference it again, all of the information is just right here. So with a conventional loan, there are fixed and variable rates. Variable rates mean, like, when rates first started going up, it was almost better to put somebody in a variable rate, or what's called an ARM, adjustable rate mortgage, because we were able to get people in at a lower rate that wouldn't even get close to adjusting to as high as the rates were at the time. That's gone now. unfortunately, things have just gone up so much that even an adjustable rate isn't going to be good for you right now. And what that means is on an adjustable rate mortgage, your rate is set at one specific rate, and then it will adjust up according to how the market is doing. So it could increase, but there is also a cap on how much it can increase. And so you'll hear people say it's a 2.5 or, whatever the numbers are, that tells you the adjustment period and how much it can increase during that adjustment period. Okay. I'm not going to go into full detail because
it can't go up crazy high. There's actually a cap. Right. So
there is a cap within a certain amount of time. A fixed rate is what most people go with because it's going to remain the same throughout the remainder of your loan. Only thing that could increase your home payment, your mortgage, would be your insurance increasing and your property taxes increasing. But the principal interest will stay the same throughout the course of the loan. So usually conventional loans have lower interest rates. They have fewer penalties and fees. Most loans now come with no prepayment penalties. And a lot of people will ask that, like, what if I want to pay it off early? What if I bought the house and then all of a sudden these things go wrong with it and I need to sell? Am I going to get penalized for selling the home? Most of them do not have that penalty.
But it used to be like that a long time ago, right?
It did.
Okay. So They're working with you. They're working with you.
They are. So a conventional loan, you can purchase a second home or an investment property with, which is good news for people that have funds and want to grow their financial wealth by investing in real estate. This would be the most likely loan that you would go with, is a conventional. So conventional loans are good for good credit. The better credit you have, the better rates you have. And that's why we always tell people, it doesn't matter really how good your credit is. If you ask me to quote you a rate, it's really going to depend on a few factors. Credit is one of them. Mm-hmm. Debt to income ratio is another, and loan to value, meaning how much you're putting down and how much you're financing. All of those things factor into your interest rate. So
I got a question. So if I had, like, let's say I have a little bit, I don't know, let's say I'm have like a 620 credit. So I can get the loan, let's say, right? Mm-hmm. Is that okay? So I can get the loan, but let's say that if for some reason, let's say I could do something to bring it up, would my rate would go down though, right?
It would. Mm-hmm. So, and we can run simulators.
If I'm at the border of the next one, like to the next thing, could you help me make it so that I can definitely get the better rate then?
Yes, and when I look up pricing in my pricing engine, it will show me what the next tier is for your credit to go up in order to get to that next level of pricing.
Perfect.
So that's always good news.
All right.
The other slides are going to go into more detail, so I'm just going to kind of run through these. So FHA has a low down payment option. It's great for first-time home buyers, but it's not limited to first-time home buyers. There's flexible income requirements and credit requirements. USDA, more in a rural area, so places that have acreage that are outside county limits most of the time. But once, like I mentioned last week, if you find a property that you like, I can look it up in the USDA tracker. You could do it yourself as well, but it requires no down payment, so that's a good thing. VA is geared towards veterans. So if you are not a veteran, you will not qualify for this loan. And even active duty military service members have to have at least 2 years in service before they can actually access their certificate of eligibility. They want to make sure you're not going to just join for the VA loan and then you're going to get out.
Right. Okay.
So you don't have, it's not required to have a down payment for the VA loan at all. Low income and credit requirements. So they go as low as $580 and no mortgage insurance. And then jumbo loans we talked about are ones that are over that conforming loan limit. And that number is on one of the next slides. But anybody that's looking to finance a home over that conforming loan limit would have to go with a jumbo loan.
Gotcha. All right.
So conventional.
We're going to talk about conventional loans, a little bit more detail here. Okay.
Yep, a lot more detail. So 3, 5, 10, 15, as low as 3, and that's definitely for first-time home buyers. If you are not a first-time home buyer, that 3% is not applicable to you. But you can go as low as 5%, and a lot of people don't realize that. The thing is, if you put down less than 20%, you are required to carry something called mortgage insurance, and that protects the lender of your money from any default on the loan. So it's just a protection for the lender. So it does add a little bit to your mortgage payment. And of course, the more you put down, the less mortgage insurance you pay. But if you have more than 20%, you're not going to have any mortgage insurance. The nice thing about a conventional loan is once you hit 20% equity in your home, that mortgage insurance will automatically drop off. So that's
So you don't have to call them, right?
You don't have to call them, but if you wanted to get it off earlier, you can definitely call them once you hit that 20%, just to make sure it's on their radar to get it done.
Okay. Because I think we had to call, but this has been a long, long time ago. So, Okay. All right. Cool. Let's talk about credit scores. Oh, no, we're talking about maximum mortgage amount. Sorry. Jumping ahead.
We touched on that just for a second. So this is the number 766, 550 is the max that you can do on a conforming, is what we call this, a conforming conventional loan. Anything above that,
right?
This
is in Kitsap County, though, right?
This is nationwide.
Nationwide. Okay. Just want to make sure, because sometimes there's like stuff for certain counties and sometimes there's not. So I just wanted to verify that. Okay.
That's the next slide for FHA.
Okay.
So we'll get into that one. So credit score requirements, 620. So it is, a lot of people don't realize 620, they think they have to have a 700 or above in order to get a mortgage, but that's just not true. We just said previously, though, it will affect your interest rate.
Yeah.
This past year, the government decided to put in what they call loan level price adjustments. And so they are charging people more for rates if their credit score is lower, if their debt to income ratio is too high, and if they're not putting as much down. It works against you. So that was just their way of kind of recouping some of the money that was lost during COVID, during some of the forbearance periods. So qualifying ratios, this has changed over time because of people needing to be able to get into homes. It used to be capped at 41% of your gross income. And that would be your housing expense plus anything that reports on a credit report.
Okay. So that would be like your car payment. That would be any credit card bills, those kind of things, right?
Correct.
Okay. Just making sure.
The only thing that wouldn't count that's on your credit card bill is if you had tried to boost your credit by adding utilities. Those would not count. We negate those from your liabilities because those are something everybody basically pays for.
Gotcha. Okay.
So qualifying ratios are determined through our automated underwriting system. We call it AUS for Fannie Mae, DU for Freddie Mac. It's desktop underwriter or automated underwriting system. Okay. So if something is a red flag, it will tell us on there what is wrong and why it's not going to qualify. And our underwriters will go and underwrite the file based on what comes up on those automated underwriting systems, which is really good.
Okay. And that's usually pretty quick, right?
Mm-hmm.
Okay.
We are able to do it and we get a response in less than a minute.
Nice. Okay.
Yeah. And that's something that we do when we're doing your pre-approval. That's what makes a solid pre-approval is running it through the system. Today, I just cannot talk. Oh my God.
Okay. You know what? And we're going to keep it kind of shorter today. So it works out great because I still got it. So.
And we might just be able to get through, this conventional and FHA this time. And then
probably just this one, actually.
Okay. That sounds good.
Okay.
So seller concessions are something that is definitely had gone away during COVID when things were really competitive, but we've seen them come back. And so you can ask the seller for a credit to help pay for your closing costs. And one thing that Fairway has recently introduced that I don't think any other company is doing right now is you can actually use that seller credit to cover your mortgage payment for as many months as it would cover. So if you're currently in a lease and you don't want to pay to break that lease, the seller credit could be used to pay for up to 4 or 5 months of your mortgage in order to help you purchase your home, but not lose money from breaking your lease. So that's definitely something to keep in mind.
Yes, and sometimes sellers will give it and sometimes they won't. It just kind of depends on the seller.
It really does. And I've seen in the past where the seller will increase the sales price, and as long as the home can appraise for that increased sales price, they'll just basically say, I'm going to raise it by $5,000 and then give you $5,000 in seller credit. You're basically paying for your own credit.
Right. So let's go back through that one more time really quickly. And we'll touch on this stuff as we go through this process, and we're going to go through this a little bit more detail. But what she said though is that, and that's really typical. I mean, a lot of times, like buyers don't have a lot of cash on hand. I mean, they've got a lot of credit, but they don't have cash on hand. So in order for them to pay for some of the closing costs, which are, could be your origination fees, it could be your title and escrow, any of that kind of stuff, a lot of times what will happen is they will ask the seller to give them what's called a seller concession. And then, but that usually involves, the seller saying, okay, well, I'm going to give you this. So what are you going to give me? Well, I'm going to raise the price. But as Kerri mentioned, it is something that's going to have to appraise if you're getting a loan, because the bank isn't going to loan on more than what the house is worth. So
correct.
Great information today. Kerri, thank you so much. I appreciate that. Again, I have to keep it at a certain thing because I had to go to swim practice.
No problem. And it's a lot of information.
I know it does. But we do want to keep these short because we want them in small blocks of information. So that way you can kind of sit back and digest it and figure it out. Again, if you've got questions, comments, please hit that like or subscribe button, throw in comments in any of the, wherever you're seeing this at. Go ahead and ask some questions. We'd love to answer those for you. And we'll do that. And we'll hit FHA next week and we'll see how we do on that, and we'll move from there. So hopefully we can get through a couple of those next week. You guys, thank you so much for joining us. We appreciate you watching. Hit that like, subscribe, follow button, and we will see you next week. Same time, same place.
Bye, everyone.